Hey everybody, Boris Slots for BK Forex. Welcome to our Forex Weekly Technicals for 05/0/10/2014. Where are the trades? Well, definitely a little bit of a pickup in action today, although it's still very much of a muted week in the currencies. You can see the euro dollar still trading this 38.39 range. We've moved a whopping maybe 40-50 points in the range. The range used to be, just want to adjust my charts here. Range was 38.50. Now we've expanded it to 38.80, 38.90. But either way, euro dollar just still remains in a monstrously tight range. Essentially, it's really incredible if you think about this. For the whole month of April, the range has been 100 points. I don't think we've seen such tight trading in the currency market in years. And the fact that we've just only had about 100 points worth of compression is a function of the fact that the interest rate market's really compressing on both sides. So you have European rates coming down, you have U.S. rates coming down. And the important part is that you have U.S. rates coming down. This does not allow the euro to come down. This is really what's propping the euro up. And even post today's NFP, which were ostensibly better on a headline basis, they still had a negative impact on the U.S. rates market. That's what caused the rally in the euro dollar. It will remain essentially around this 38.39. Next week comes the ECB meeting. It's going to be an interesting event, I think, in many ways, because although I've been very skeptical about the idea that the ECB may want to cut rates or may be willing to cut rates, at this point, depending on how the euro trades, especially if we can bust out above 39s ahead of the meeting, the pressure on the ECB to want to try to move this thing down is going to increase exponentially. They may not have a choice but have their policy kind of forced on them, and therefore lower rates, try to push the euro down to the downside, because they're certainly not getting any help on the U.S. rate side, and that's keeping the euro up artificially too high for any kind of significant recovery in the eurozone to take place. Technically, when you're looking at this whole chart, it still looks positive euro, and in fact, a break above 39 and a hold above 39 would most definitely provide a potential setup for a run all the way out to the key 140 level. I mean, when you're looking at this, essentially on a technical basis, we have a series of higher lows. We have a very sharp recovery today. All of it on a technical basis still looks relatively positive. And as I said, a break above 39 and a hold above 39 just puts us into a very strong position to run towards the 140. We're still operating against this double top, but a hold above 139, this is a critical thing, I think really puts a much more constructive focus on the trade. Conversely, breakdowns have been non-existent. That is, every time we've tested the 38, it's just held. So what if the ECB comes in super negative? What if they can just crush the euro by saying, hey, we're going to cut rates, we're going to do QE, we're going to throw everything but the kitchen sink? In that situation, then the technical structure really turns much more negative, because then you would be having a series of higher lows operating against a break of the 38s, which could potentially certainly generate enough momentum for us to test the 37s, and ultimately, if we have a really strong downward move, all the way out to 36s. But still, in the grander scheme of things, when we're talking about a massive move, we're talking about a 200-point move, something that used to happen on a lunch hour in 2009. So volatility has really compressed. It's not your grandfather's market. It's a very tough market to trade, and therefore you have to make adjustments accordingly. Now, looking at the yen, same kind of a story. Huge reversal off rates, really negative. This is just an ugly candle. Technically, this candle is quite ugly. But and this is a key thing though. I've seen many times where you have this kind of a candle, and it's just very tempting to short off this candle because it's a reversal candle, but it's really not a reversal candle. This is a bear trap candle in many ways. What I mean by that is it's very important to have a confirm of this breakdown happen if you want to make sure that this is a legitimate negative move. Very often you will get this kind of a breakdown, and then technically you actually will spend time consolidating and then recovering this whole move. And so if you're short, you're basically going to get squeezed out all the way up and possibly through the 103s. So to me, the short trade here really has to be a sell through the 102s and a considerable 102s, not just like the 102.90s, probably around 102.70, 102.65 as a potential short sell, because that would create enough momentum here. Although you're running into the 102.50s as a potential break, so that's a tough quadruple bottom here that you're going to be facing. But even if you sort of sell the 102.70s, at least you have some room, and at least you have a confirmation the 102s get broken in a significant fashion. Ultimately, though, you really need this 101.50 break to come down all the way down to 101s. So yes, this is negative, but it's also could be potentially a bear trap. I'd be very careful about shorting dollar yen right now until and unless I could get at least into the 101.80s, 101.70s as a potential entry. Cable is having a tough time again at this 69.50 and 6900, 69.50. You know, what was the flame out here? 69.19. My friend Adam Button from Forex Live really thinks this needs a correction. He's betting on the fact that it's not going to make 170. So this could be interesting to me. He may be right, and I think the buy point here. You almost really have to have a buy point above the 69.50, not just a buy point of the highs, but a buy point of 69.50 or higher, in order to feel relatively confident that you're going to move towards the 170. So if you do take 69.50, the natural momentum move towards 170 becomes much greater. Until and unless then, it's actually a relatively low risk short trade, right? So you have about 100 points of stoppage against a short position. If you believe this is a near-term top and exhaustion move, it's not a bad position to consider a potential short position against the 69.50 stop in cable. Aussie is just kind of dead money. It's been 93, 92.50, 93. We dipped on the initial move here in the pro dollar forces to 92s, but Aussie on a relative basis to me still looks relatively weak. Although today's move, this is a relatively impressive move to the upside, suggests that maybe there is some decent support here at 92s. Whether you want to try to sell Aussie on the crosses, I think is an open question. So pound Aussie, just to take a look at something that's been working well to the upside, the short Aussie move. Pound Aussie now has kind of shown this kind of flame out basis. Another interesting possibility. This is so if you sort of bet on the idea that pound has flamed out, right? Then pound Aussie, as a matter of fact, could be an interesting short as well. Not because I love Aussie, but because I think the pound will correct and the Aussie may just simply stay stationary. And as a cross trade, it could be an interesting move to consider. Kiwi is actually doing halfway decently. Kiwi is doing quite well, actually. And this is another thing that is interesting, that while you may be positive Aussie against pound, the one thing that I've been watching this whole week is, and this is a natural short trade. It really deserves to be a short trade because the fundamental interest rate differential here is clearly expanding. It's deep into the short trade. In other words, you've already had the key breakdowns here below the 107s, but I still think it's just the beginning of the leg. I mean, here essentially a break above 108 would negate a lot of this short momentum action, but the fact that we have a pretty decent beginning of a momentum to the downside suggests that you could certainly expand towards the 106s, possibly the 105s. You basically have potentially another 200 points of downside action against 100 points worth of risk in the Aussie Kiwi, given the natural fundamental differentiation in interest rate between the two countries. And I think that's an interesting trade also on a cross basis to consider as we go forward. Aussie, Kiwi itself, certainly acting much better. Although it is going to be facing this resist here at 87, 87.50 on a stiff basis. But still, that's 100 points that it can try to make for a double top, which in turn could push Aussie Kiwi all the way down to 106s, 105.50s. So to me, that's an interesting side bet this week as we look around. Aside from that, looking at just the yen crosses, which have been dead in the water. Again, if the yen breaks down, let's say we have risk aversion, we have Ukraine, who knows what's going to happen next week. If the yen starts to break down, we have, and of course this is another example of where's the pound weakness. Pound weakness against the Aussie, pound weakness possibly against the yen here as well. The fact that we turned at the 73 handle suggest that maybe, yeah, this is all picking tops. Something I really don't necessarily love to do, but the charts are really setting up as potential top formations, especially in the pound complex, and they're definitely worth watching. And certainly with very, very, very low risk parameters here in terms of not being far away at the stop points to consider. So pound yen looks kind of decent to the downside. Euro yen, less so. And euro yen is just simply dead money. It's been dead money. I mean, this is to me is sort of the poster child for what everything that's driving us crazy in the currency market today is euro yen. One of the greatest volatility trades in the currency market has literally died. You might as well just put a tombstone on this pair. If anybody could tell you that euro yen would do 100 points worth of volatility over a month's worth of time, you'd be laughed out of a room, and yet this is exactly where we're at. So in many ways, I think this is also actually an interesting poster child to see if when volatility will return. When this thing breaks out, when we either take down, break down to below 140s, take out the 143s, that is when volatility may finally come back, because this seems to be the true description of exactly what's happening in the market right now. So anyways, that's how it sets up. Next week, it's going to be ECB as a event risk, and it could be the correction in the pound. So the pound against yen, pound against Aussie, maybe the trades, and the other stuff that is developing is the Aussie Kiwi to the short side is picking up momentum, and that's certainly worth taking a look at as the week develops. Wishing you guys the best of luck, the best of trading. Boris Schlossberg, over and out.